Welcome, curious minds, to the deep dive. Today we're cutting straight to the wisdom of one of the true legends in business and investing, Warren Buffett. We've pulled together a fascinating stack of his insights, from shareholder letters, interviews, really trying to unearth the core principles he lives and works by.
And what's interesting here, I think, is that we're aiming to go beyond just the numbers, beyond the balance sheets. This deep dive, it's really about uncovering those foundational philosophies, the human element that's often missed, and maybe some surprising lessons from the Sage of Omaha. Our mission really is to pull out those core nuggets of knowledge, things that can maybe transform how you think about money, sure, but maybe even your approach to life.
Exactly.
Yeah.
Now, think of it as getting a peek inside the mind of a master. We'll explore his unique takes on finding great businesses, managing people, even how he thinks about his own day. So, what does this all mean for you? Let's unpack it. Okay, so let's start with what really seems to set Buffett apart. It's not just the investing skill, right? It's this deep belief in people, in culture. For him, business isn't just clinical. It seems deeply personal.
You're absolutely right. If you look at the big picture, he frames his whole approach around this idea of shareholders as actual partners, real partners. He and Charlie Munger, they make sure their own financial fates move, quote, in lockstep with the shareholders. They hold mostly Berkshire shares. They don't want big salaries, no stock options that give them some kind of edge. He even joked, if they do something dumb, he wants you to feel better knowing they're suffering financially right alongside you. It's total alignment.
That's just it. It's so different from how many companies operate today. And it gets really interesting when you look at acquisitions, doesn't it?
Yeah.
He has this philosophy. He doesn't see businesses as just merchandise to be bought and sold quickly.
No, not at all like some private equity thinking where the exit is planned from day one. He buys to keep. It's more like adopting a business into the family. He looks for sellers who genuinely care about what happens to their company long term.
Like that famous story with Nebraska Furniture Mart, NFM.
Exactly, NFM. And Mrs. B, Rose Blumkin, an incredible story.
Started with just $500 back in 1937, couldn't read or write, worked till she was 103. Amazing. What did that deal show us?
Well, the way Buffett describes it tells you everything. He said he gave Mrs. B a check for, what, $55 million?
Yeah.
And she gave us her word. That made for an even exchange. Just think about that. It highlights this incredible trust he places in character and reputation over stacks of legal documents. It's pretty rare.
And he genuinely admired her. Said she cared and she was smart, knew her limits, but was confident inside her circle of competence. He thought she proved that just taking care of customers is what it's all about. Said every business school should study her.
Which raises that key question. Why does he value owners like Mrs. B so much? It's because that emotional attachment, as he calls it, usually signals things like honest accounting, real pride in the product, respect for customers. It's the opposite of what he terms financial owners who might, dress up a business just to sell it, maybe playing games with the numbers.
Okay, so he buys these businesses from people he trusts. What happens then? What does it mean for the managers running these companies within Berkshire?
It means autonomy. Like autonomy to an extraordinary degree. Buffett is very clear. We adapt to their methods rather than vice versa. He and Munger, they don't second guess. They deliberately don't have operating people at headquarters trying to run these businesses from afar. This whole approach, it lets the managers really love their businesses, think like owners, and exude integrity and ability. They're not just reporting up a chain.
And the overall culture at Berkshire itself, how does he describe that?
He calls it old-fashioned, like Ben Franklin's or Andrew Carnegie's, very focused on fundamentals, very conservative in a way. And the absolute top priority, zealously guard Berkshire's reputation. Buffett puts it bluntly, we can afford to lose money, even a lot of money, but we can't afford to lose reputation, even a shred of reputation. Every single action is measured against this standard. Would we be happy seeing this written up on the front page by an unfriendly but smart reporter?
Wow. That's a powerful test, isn't it? Simple, but really profound. Something you could apply in your own life, professionally or personally. Okay, moving on from the people side. Obviously, Buffett is known as a master investor, but his approach It isn't about chasing trends or using complex models, is it? It's more about deep understanding, long-term vision.
Right. And what's so refreshing is how simple he makes it sound. His definition of a good investment, basically, to purchase at a rational price, a part interest in an easily understandable business whose earnings are virtually certain to be higher 5, 10, and 15 years from now. Simple as that. He even says you don't need to understand, beta, efficient markets, modern portfolio theory.
He jokes you might be better off not knowing that stuff.
Exactly. The focus is just on the business fundamentals, the future earnings power, not market noise or academic theories.
And talking about finding those great businesses, his long relationship with Geico really shows this long-term thinking in action.
Oh, absolutely. He called Geico his first business love. Can you believe he put 3/4 of his net worth into it when he was just 20?
Incredible.
Yeah.
But he also talks about making a mistake there, right? Selling too early.
He does. He's very open about it. He sold his shares in 1952 for about $15,000.
Which sounds like a lot back then, maybe, but
But then he watched that same stake balloon to over $1.3 million in the next 20 years.
ouch. What was the lesson there?
He said it taught him a lesson about the inadvisability of selling a stake in an identifiably wonderful company. Don't sell your winners, basically. So later, he bought more, and eventually Berkshire acquired the whole company. Why? Because its fundamental business, its advantage, was exceptional for precisely the same reasons that prevailed in 1951, decades later.
And once they owned it outright, he set it up so the managers like Tony Nicely could just focus, free them from board meetings, press interviews, investment banker presentations, all that stuff. Just run the business.
Almost like creating a protective bubble so they could focus purely on insurance.
But this philosophy, this focus on understandable long-term holds, it really contrasts with something like the derivatives business he inherited with General Re. That sounds like a nightmare.
It certainly wasn't his kind of business. He called derivatives unattractive and dangerous. For anyone listening, derivatives are basically complex financial contracts whose value depends on some underlying asset, like a stock or commodity price. And unwinding the huge book they inherited, 23,218 contracts, took 5 years and cost Berkshire over $400 million in losses. A huge headache.
And that famous quote, "You only learn who's been swimming naked when the tide goes out." That must have come straight from that experience, right? Seeing what was really under the surface there.
You have to think so. It was a painful lesson. He also had that other great line about derivatives. Like hell, derivative trading is easy to enter but difficult to leave.
So why is he so wary? What's the core danger he sees?
Well, he points to a few things. One is daisy chain risk. How trouble at one firm can spread like wildfire through the system because everyone's interconnected. And then there's the sheer complexity. He argues auditors can't audit these contracts and regulators can't regulate them properly. He felt a lot of the valuations, the mark-to-market prices, were becoming mark-to-myth, just fantasy numbers, really.
Okay, so he avoids that kind of complex, opaque risk. But how do he and Charlie Munger think about risk in their main businesses, like insurance?
They're very disciplined. They say they detest taking even small risks unless we feel we are being adequately compensated for doing so. It's all about the price. They stick to what they know their circle of competence. They try hard not to let losses pile up from one single event, like avoiding too much mega catastrophe insurance in one place. And they absolutely avoid moral risk, basically, doing business with bad people. But they're not totally risk averse. They're perfectly willing to lose $6 billion in a single event if they've been paid properly for taking that specific risk. It's calculated.
And interesting that they warn against relying too much on computer models for risk assessment.
Yeah, they worry those models can create a false sense of security, making decision makers more likely to make a really huge mistake. Very timely warning, I think.
So investing involves understanding businesses, and that leads right into how they're managed. Given Buffett's board experience and what he's seen, let's talk about leadership and governance.
Right, and he's incredibly direct here, doesn't mince words about executive behavior. He's been on lots of boards, but he jokes he became the typhoid Mary of compensation committees.
Meaning he brought an unwelcome dose of independence.
Exactly.
Yeah.
He wasn't just there to rubber stamp things, so he says he got rejected from serving on many of them.
And he really goes after compensation committees that act like, what was it, tail-wagging puppy dogs. Just meekly following consultants, using that excuse of, "Mom, all the other kids have one," for
Yeah.
crazy perks and pay packages.
Yeah, he's very critical of how the bloated pay of recent years just becomes the new floor, the new baseline for the next year's negotiations. His view is pretty stark. Directors should not serve on compensation committees unless they are themselves capable of negotiating on behalf of owners. They need to act like it's their own money at stake.
And those huge severance packages, the golden parachutes.
Oh, he points out the absurdity, how a CEO can sometimes earn more cleaning out his desk in one day than a worker earns in a lifetime cleaning toilets. It's a jarring comparison.
So what's his fix? How do you get real accountability, real independence on the board?
Well, it raises that question, doesn't it? How do you ensure directors are truly aligned with owners? Buffett's idea is pretty radical. He thinks directors should have very substantial personal and family ownership stakes in the company, skin in the game, and pay them only nominal fees. And get this, no directors and officers liability insurance.
Wow, no insurance.
Right. The message is crystal clear. You win, they win big. You lose, they lose big. That creates genuine alignment, he argues.
He's also got strong views on audit committees, doesn't he? Says they can't audit.
Yeah, his point is they aren't the ones doing the detailed checking. Their real job, he says, is to simply get the auditors to divulge what they know. Because often the auditors see the CEO, the management, as their client, not the shareholders they're supposed to represent. It can get too cozy.
So how do you break through that?
He actually proposes 4 specific, sharp questions the audit committee should ask the auditors. Like, if the auditor were solely responsible for preparation of the company's financial statements, would they have in any way been prepared differently? That's a powerful one. And another, is the auditor aware of any actions that have had the purpose and effect of moving revenues or expenses from one reporting period to another, really trying to uncover any manipulation?
Given all this focus on owner alignment and avoiding waste, how does Berkshire itself stay so lean? How do they maintain that cost consciousness?
He tells that great little story, the analogy about the widow placing an obituary.
Oh, yeah, the newspaper ad.
Right. She's told it's 25 cents a word. She says, okay, Fred Brown died. Then they tell her there's a 7-word minimum. So she thinks for a second and says, okay, make it, Fred Brown died, golf clubs for sale.
Huh. Get the most value out of every word.
Exactly. Maximum efficiency. And that ethos apparently translates directly to Berkshire. They operate with incredibly low overhead, under 1% of our reported operating earnings after tax. It's astonishingly lean for their size.
It really is. And he makes that point about corporate leaders complaining about government waste.
Yeah, he finds the hypocrisy funny. He tells that story from his time at Salomon Brothers. Executives got free haircuts from Jimmy the Barber, but the moment they were asked to actually pay for the haircuts themselves,
What happened?
one executive immediately switched to a once every 3 weeks schedule. It just shows, as Buffett puts it, how the financial behavior of executives will also vary based on whose wallet is getting depleted. It's human nature.
Absolutely. So true. Okay, let's shift to learning. Buffett is famous for being candid, especially about his own mistakes. He literally wrote a section called Mistakes I've Made.
He did, and it's fascinating. He talks about his early cigar butt approach. You know, buying these really cheap, often lousy businesses like the original Berkshire Hathaway textile mill, just looking for one last puff of value. But he realized that was flawed. He learned the hard way that time is the friend of the wonderful business, the enemy of the mediocre. Holding on to a mediocre business, even if bought cheap, just drags you down over time.
So that was a huge shift. He learned it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that analogy about jockeys and horses, good jockeys will do well on good horses, but not on broken down nags. Focus on the quality of the business itself.
Precisely. So this raises the question, how does he handle problems now after learning these lessons? His answer is surprisingly simple. What we have learned is to avoid them. He says his success isn't about superhuman ability to solve complex problems. It's about identifying 1-foot hurdles that we could step over rather than because we acquired any ability to clear 7-footers. Know your limits, stay in your circle.
But he still makes mistakes, and he owns up to them, like missing Fannie Mae.
Oh yeah, he calls it thumb-sucking. Says dithering on that one costs shareholders something like $1.4 billion. A huge miss. But maybe his self-described worst deal ever was buying Dexter shoes.
It's a shoe company. What was so bad about that one?
It wasn't just that the business turned out to be, in his words, worthless. It was how he paid for it. He used Berkshire stock, so he effectively traded away 1.6% of his wonderful Berkshire Hathaway business for a business that went nowhere. And because Berkshire stock kept soaring, the cost of that mistake compounded massively over time. He calculated it as a $3.5 billion error for shareholders. A painful lesson in using your own valuable stock.
Wow. That really puts the cost of mistakes into perspective. Okay, beyond business and investing, Buffett often acts like a teacher, especially for young people. What does he say is the most important investment of all?
Without a doubt, investing in yourself. He uses this really powerful analogy. He says, imagine you're 16 and a genie offers you the car of your dreams. Any car.
Oh.
But here's the catch. It's the only car you will ever get in your entire life. That's it.
Right. Okay, so you treat it incredibly carefully.
Exactly. You'd read the manual, garage it, change the oil religiously, fix every tiny bit of rust immediately, because you know it has to last you a lifetime.
So the connection is treat your mind and body the same way.
Precisely. He says you get only one body and one mind. You'd better treat them the same way. You have to maintain them, protect them, because they're all you've got. And he advises students to focus on cultivating three things: integrity, intelligence, and energy.
Integrity, intelligence, energy. Okay.
But then he adds that crucial point about integrity. If someone lacks integrity, he says, you actually want them to be dumb and lazy.
Why is that?
Because if the person did not have the first two, integrity and intelligence, the later two, intelligence and energy, would kill him. Basically, smart, energetic crooks are the most dangerous people. Integrity is the foundation.
That's a stark way to put it. And his advice on careers.
Find your passion. He says, it is a terrible mistake to sleepwalk through your life. He loves his job, would choose it again. And his practical tip, go work for an organization you admire or an individual you admire. Surround yourself with people and missions you believe in.
He also have that exercise he does with students, right?
Yeah.
About buying a piece of a classmate.
Yes. It's brilliant. He asks them to imagine they could buy 10% of the future earnings of just one of their classmates for the rest of that person's life. Who would they choose?
And the point is, it's probably not the one with the highest IQ or the best grades.
Exactly. He says you look for the person who is generous, honest, and who gave credit to other people. You'd pick based on character.
So the qualities that lead to long-term success, behavior, temperament, character, these are things anyone can cultivate. They're achievable, he says.
Right. They're choices we make. But he adds that warning, doesn't he? The chains of habit are too light to be felt until they are too heavy to be broken. Start building good habits early.
It's powerful advice.
So as we wrap up this deep dive into Buffett's world, it really strikes me how much it comes back to these timeless truths, doesn't it? Things like integrity, taking the long view, valuing people genuinely, learning constantly, especially from mistakes. It's all about building that strong moat, not just around your business, but maybe more importantly around your own character.
Absolutely. You see it from Mrs. B's simple promise keeping customers happy all the way to Buffett owning his own huge errors like Dexter's shoes. The lessons are so consistent. It's not about some secret formula or chasing fads. It's about understanding fundamentals, understanding people, and sticking to your principles. And remembering that line about habits, the chains of habit are too light to be felt until they are too heavy to be broken. So maybe something to think about as you go about your day. What's one small habit you can start building today? Something that might widen the moat around your own future success, making it, as he might say, easy to enter the outcomes you want and difficult to leave your goals behind.